This is the Conference Board's Leading Economic Indicators Index, an index that has successfully predicted every recession since 1980, and right now is predicting a recession, a pretty major one at that. The index uses forward-looking metrics to get an idea of what the health of the economy will be in the future, and has now declined for 19 months straight, the longest period of declines since the global financial crisis. Now, this index takes 10 key metrics, including the likes of jobless claims, average work week, building permits, stock prices, credit, interest rate spread, and various order types. It also does take into account the average consumer expectation and sentiment of the economy. Now, despite some economists and financial organisations predicting a soft landing, this leading economic indicators index is showing a continuous downward trajectory with no signs of recovering at all. And since 1980, every time we have crossed the minus 5% threshold on the year-over-year view of this index, we have simultaneously been in a period of recession, as shown by the periods shaded in light red on the chart. And this does include the global financial crisis, the dot-com bubble, the 1990s recession, and the 1980s recession. And as you can see, as of today, the index does come in at minus 7.6% and has exceeded this minus 5% threshold for some time now, dating back to 2022. We are now entering dangerous territory if historic data on this index is anything to judge by, and alarm bells are ringing loud and clear on what could be about to happen next. Now, Ray Dalio has also sent a major warning when he appeared on a CNBC interview last week, in which he said that the US is nearing an inflection point in which the debt problems could get even worse and spiral out of control. Now, Ray does say that bond yields have to cover inflation over the given duration, as well as offer a real interest rate on top of that. But he does say that the big question is the supply and demand of bonds, in which the supply is coming from the government issuing new debt to cover their budget deficit. He does believe that there is a big risk that there is no longer enough of an appetite from investors for these bonds, which poses a big risk to the government selling these bonds. He points out that many of these investors who have owned bonds in recent years have suffered big losses in them, and this is not just Wall Street banks, but central banks across the world as well. And looking forward, Ray believes that we have a debt problem because the US is adding to their debt faster than they are adding to their income, which is leading to a rise in the real interest rate needed for the investor to get an adequate return. Meanwhile, there is an increasing supply and demand imbalance in which there are not enough buyers left in the bond market to meet the growing supply that is being put out there by the US government. Now, Ray also highlights that the government is spending more money than ever before to pay interest on existing debt, and therefore needs to keep borrowing new money to continue paying off this debt. He says that when you have a debt growth faster than income growth, then the cost of debt servicing encroaches on the ability to spend to stimulate the economy. This encroachment on spending ability accelerates at an exponential rate, and Ray believes that we are now at that inflection point where the acceleration of this debt becomes a big problem. We know that the banking sector is also really feeling the stress right now from the current high interest rates and the economic conditions that come from this. There has been a surge in banks tightening their credit standards for commercial and industrial loans, which has peaked above 50%, typically a signal of a recession based on historic data. Although we have since dropped slightly back down to 33.9%, the trend of banks tightening their lending standards is likely to remain and is a bad thing for the economy as credit stimulates economic growth. Now, if businesses cannot access credit as easily as they once could, then this stunts economic growth and can lead to projects being called off and workers being laid off. But it also means that banks are not able to balance out their loan books as easily with new high interest loans to offset their older low interest loans that are generating a lower yield than what they have to currently pay out on customer deposits. And as a result of these surging interest rates, we have seen the net interest margin shrink across many banks, which is the difference between the average yield received from loans and the average yield paid out on customer deposits. This puts pressure on the banks and can lead to layoffs, branch closures, and of course, in more serious cases, complete banking failure, like most recently on the 3rd of November this year with Citizens Bank. We know that the banks are also sitting on $684 billion of unrealized losses on their securities right now, which includes various types of government bonds, corporate bonds, and other types of loans. Now, this is because the underlying asset for these bonds has been decimated over the last couple of years thanks to interest rates surging and the yield on these bonds readjusting because of this. Although many of these bonds can be held to maturity, meaning that the unrealized losses will be wiped clean once the duration ends, it still means that this money is essentially trapped in these bonds. And as the value cannot be retrieved by selling these bonds, banks will have a big hole in their balance sheets that will stop them from getting access to additional funds should they need to if a significant credit event was to occur. Banks need to be liquid to operate properly, and with so much money tied up in assets that are down so much in value, selling them would inflict billions of dollars worth of realized losses onto the balance sheet. And when it comes to high-yield corporate loans, we are starting to see a surge in defaults take place, meaning that borrowers have simply stopped paying back on their loans. Companies that are not yet making profit or operating in more risky industries, as well as corporate real estate companies, are faced with the option of either refinancing their existing loan at a much higher interest rate or completely paying off the loan. Now, many of these loans were at 3 to 4%, but are now having to be refinanced at closer to 10%, or in some cases even higher, which is simply not doable for struggling corporations. A default cycle looks to have started, with the default rates on speculative grade loans and high yield bonds surging since 2022 when the Fed started to raise rates. And as you can see from this chart, this same pattern of surge in defaults occurred during the dot-com bubble as well as during the global financial crisis, meaning that we could be at the start of a larger problem. And when we look at the high yield maturity wall that we are facing in the coming years, it becomes clear that the rise in defaults we are seeing already in 2023 is just the warm-up, and things are about to get a whole lot worse in the coming years. In fact, the amount of debt maturing gets higher and higher each year, peaking in 2026, where it will be more than double the figure in 2023. Now, the total number of employees at companies which are in this US high yield index is 11 million, while in the leveraged loan index it is 8 million. And with interest rates set to remain high until at least midway through 2024, there is likely to be a number of bankruptcies and layoffs taking place across these sectors, which fits the Fed's goal of softening the labour market and lowering inflation. A general increase in the unemployment rate across the entire economy was already expected if historic data is anything to go by, as we can see that there is a strong lagging correlation between interest rates and the unemployment rate. Throughout history, as interest rates have gone up, the unemployment rate has also gone up, lagging behind by a few years. Considering that unemployment is currently at record low levels and that interest rates started to increase at record-breaking pace in 2022, it is likely that we see a surge in the unemployment rate starting sometime in 2024. A worsening labour market and a surge in layoffs and unemployment on the horizon is only part of the pain that the US consumer is suffering from right now, and the data certainly suggests that things are very bad right now. At the moment, the cost of housing is sky high, with monthly payments on new mortgages now close to double what they were in 2020 thanks to the surge in mortgage rates. And the cost of renting has also been ticking upwards for the last few years too, meaning that many people are spending far more on housing than they were a few years ago. And with other things in the economy like energy, food and general day-to-day costs also rising significantly thanks to the high inflation that we have seen recently, consumers have suffered a major blow to their spending power. Consumers are depleting their savings and are now saving far less of their income compared to at any point in recent history. At the same time, many consumers are racking up increased credit card debt, which has now exceeded $1 trillion for the first time in history. Alongside this, the interest rate being paid on this credit card debt is now far higher than it has been at any point in recent history, at approximately 23%. This double hit of high credit card debt being serviced at a high interest rate is clearly having a big impact to many people's finances, as we are seeing a noticeable increase in credit card delinquencies. And despite some consumers relying on credit cards to keep up with previous spending habits from several years ago when the economy was in a better state, there has still been a noticeable decline in retail sales overall. In October, we saw retail sales drop significantly from previous months, which could also be due to student loan payments resuming. And in general, we have seen retail sales slow down consistently every month since the Fed started raising rates. There are clearly a lot of things going on right now in the economy, with many signals that a major recession is coming soon. The housing market specifically looks like it is in a massive bubble right now and looks set for a major correction over the coming years, which could have catastrophic knock-on effects across the entire economy. I went into more detail on this in my recent video, which you can check out by clicking on screen right now. Aside from that, please leave a like and subscribe if you enjoyed the video. That does help out the channel a lot, and thanks a lot for watching.